So I'm going to talk about AI applications in investments and managerial decision making. So I'll start with the major fields in finance that we are examining these days, right? Asset pricing, how you price assets is definitely important. How you make corporate decisions, be it investment decisions or financing decisions, would be important. And there are potentially other applications in financial intermediation, banking, market microstructure or macroeconomic prediction, so on and so forth. What I will focus on today would be the two major fields within finance. Number one, asset pricing. Number two, corporate finance. Now, within asset pricing, I would say there are two main directions that we can think about applying AI or big data analytics. One is recovering the stochastic discount factor. Sometimes it's called pricing kernel. It's equivalent to recovering some risk premia. Um, if we believe the asset prices or returns are driven by certain risk factors. So that's about the pricing side. In terms of practical applications, we do care about managing portfolios, offering investment advice, and also helping people to do financial planning. And that's where some AI models will be very useful once you combine it with the right finance knowledge. On the corporate finance side, we've been looking at capital budgeting, fundraising. How do you decide to issue securities? How do you design securities? There's a lot of discussion on agency issues because managerial decisions are often delegated to the managers, and managerial characteristics matter, macroeconomic environment matter. So these are the issues that financial economists look at. So how is machine learning or AI relevant here? We have to recognize the data generating process in financial settings are quite different from that in science and engineering. So here I'm going to list a couple features. Some of them are very distinguishing features of financial data. Some of them do share similarity with the data generating process in science and engineering. Number one is just high dimensionality. That's the case in science and engineering as well. We do see a lot of kind of X variables, if we may call it that way. Now, how do we deal with that? We can do dimension reduction. We can, um, use PCA. We can use penalized regression, so on and so forth. So that's not too surprising. Second feature, nonlinearity. Again, that's not unique to financial data yet, but it's an important feature of financial data. Traditional linear models are limited in that sense. So how have economists been dealing with it? Well, we can introduce nonlinear models. We can introduce more data-driven than parametric models. And in particular, um, neural network-based models will be very relevant in capturing or extracting information from the rich financial data we have. Now, the third point is getting to something that's different from science and engineering. In social sciences, we have a lot of interactions of data. There's endogenous interaction as opposed to the variables that are relatively controlled and exogenous in a lab setting. So we have to deal with interactions instead of the sparsity issues that we typically saw in science and engineering. We have way lower signal to noise. And because of that, we have to really focus on auto sample performance, so on and so forth, in order not to overfit. And we also have to deal with non-stationarity issues. In most of the time series models we have, there's some assumption on meta-stationarity. But we know regime changes, policies change, people's preference are going to evolve based on their experience and learning. So that's why we have to use machine learning AI models to better extract information in the time series. I'm not saying machine learning AI models are going to completely take care of non-stationarity issues, but it's going to um, extract information in the time series in a data-driven way, which is helpful. And I've done some work on that as well. And if we just pull the models off the shelf from science and engineering, most of the models, AI models, I would say, are designed as a single sequence model. If it's about self-driving or machine translation, we're dealing with a single time series. But in finance, the portfolio risk management would matter, interactions across assets would matter. So I have to introduce structures or modules to extract information in the cross section. I'm going to touch on cross-asset attention network in a little bit. And finally, we typically require an economic motivation on why we use certain tools. Predictability is not the only thing we care about, right? We have to justify why in this particular setting we need this AI model, machine learning model, and ideally we want interpretability. Of course, if we can draw causal inferences, that would be even better, but I would say that's quite challenging when dealing with, let's say, deep learning models. So there has been a number of applications working on reducing the dimension, PCA-based methods, shrinkage, um, or to deal with nonlinearity interactions in terms of regression trees or neural networks. But I think what is important is that we need to modify and tailor these models for financial applications, and that would require the joint effort from computer scientists, data scientists, engineers, as well as financial economists. So today, I'm just going to give you a quick flavor of the type of applications or innovations we can do in terms of modifying or introducing AI models for finance. I'm going to touch on textual analysis, a new class of tree-based models that are very suitable for financial analysis, and applications of deep reinforcement learning. In particular, I'll share with you what we find in a project with the title AlphaPortfolio. We're essentially using an AI model for managing the portfolio. Now, let me start with tree-based models. I'm going to call it P-trees, which is short for panel trees. And this is based on, primarily based on my joint work with Gavin Fong, Jingyu He, and Xin He at City University of Hong Kong. So, and for this study, we want to look at asset pricing. And typically, how do we approach pricing assets? Well, we think about common factors that describe the returns and risk and return trade-off in the setting. And typically, sometimes we have a pharma French type factors. We have value factor, size factor, market factor. These are just aggregate systematic factors. Are they all risk-based? Not necessarily. They are just, in terms of the statistics, they are just co-movements of assets. And individual assets would have an exposure to these factors. Now, the issue we typically face is we have too many factors. We have too many signals. And dimension reduction is one way to go. But what panel trees do is we actually want to preserve the interpretability of tree-based models. So instead of using a complex neural network model, which is hard to interpret in general, we basically use regression trees, but we have to modify that to suit financial big data. And I'm going to come to that. Typically, we grow a regression or classification tree solely based on the statistical properties of the data. But for panel trees, we actually want to use economic principles to guide the growth of the tree. And that's where the innovation is going to be. So very quickly, we can write down a pricing kernel for assets I in time t plus 1. We use lowercase r to denote the return. And without having too much math here or technicality involved, it's safe to say that you can derive a pricing kernel. It's a random variable that helps price different asset returns going forward. And it can be expressed as the expected output or realization of the individual asset returns, which is denoted by R here. But we rarely use individual stocks or their variance covariance matrix to construct this pricing kernel, just because there's a lot of noise to individual stocks. So what economists typically do is we construct portfolios and use portfolios as basis assets. Presumably, the basis assets we have is going to span the return space. And then we can express the pricing kernel in terms of, oftentimes a linear combination of these portfolios. And that's going to reduce noise. So we can do that. We don't necessarily need to use trees. So why do we want to use trees? Well, If we use a tree to sort asset returns, eventually what we get is a set of leaf portfolios that can be used as test assets or basis assets. At the same time, we can use them to construct a pricing factor. So we kill two birds in one stone. So that's why using trees is good. Trees are very good at capturing nonlinear interactions, high dimensionality. It's easy to interpret. I'll come to the interpretation part in a little bit, but that's something we want to inherit from classical tree-based models. For example, the card model. Another advantage is trees are very good at dealing with low signal to noise, even compared to neural network models. Partially because trees involve a lot of averaging, right? Averaging across the nodes. Uh, Oftentimes we use ensemble methods, random forest, so on and so forth. So that reduces signal to noise. But at the same time, because we're taking averages, because we're using ensemble-based methods, we are essentially losing some interpretability. If you give me the output of a random forest, it's a little bit hard to see which variables exactly interact. And that's something we want to overcome in panel trees. Another typical assumption in tree-based models is in the time series, we typically assume a IID distribution of returns. That's just based on the plain vanilla structure of cards and card variants. Um, but we know that's not true. Over time, asset returns could evolve. Firms' exposure to assets to systematic factors could evolve. So we want to incorporate the time series dimension. How do we do that? Well, instead of putting returns in the nodes, we put a time series of returns. So we can carry out more operation along the time series in order to extract information. And instead of growing a tree based on local splits, which I'm going to come to on the next few slides, we use a global split criteria. Essentially, at each step of growing the tree, we want to make sure it's not only pricing that branch accurately, it's actually pricing all the assets quite accurately. So what do I mean by that? Well, this is a typical tree-based regression or regression tree. Essentially, we are cutting the assets or splitting the assets based on the covariates, all the X variables, predictors. And if we do this to the extreme, we're essentially using a constant to approximate tiny pieces in the covariate space. It's a little bit similar to nearest neighborhood. If we do this infinite many times, we don't do that because of curse of dimensionality, right? We still just limit it to a few steps. But the plain vanilla tree-based models are going to split asset returns based on the characteristics in a local recursive fashion. What do I mean by that? Well, I might be searching over a possible split along the market cap or a book to market value, which is value here. Um, we can standardize the input variables, and then I use a constant, let's say mu1 or mu2, to proxy for the returns of assets within that node. And what is the split criteria in general? Well, we want to minimize pricing errors once I split a node into two. Basically, I choose two constants so that the pricing error is minimized. But that's still within that branch. Ptrace is going to do it differently. We actually construct, I apologize for the font here, it's offsides a little bit, but we actually use the leaf nodes to construct a factor which is a mean variance optimized portfolio out of the leaf portfolios, and then use that factor to price individual assets by estimating a latent factor model, allowing the firm or asset characteristics to be part of the predictors for the beta loading, basically the exposure to the systematic factors. And remember, we use vectors in the nodes. So we can basically iteratively grow this, and it's still a greedy algorithm because we're using trees. Um, Alternatively, you can think about sequentially sorting assets based on their characteristics, but there are not infinite, but there are many different combinations of the characteristics that you can sequentially sort the assets. That becomes an NP hard problem. right? If we are dealing with input variables of the dimension of 50 or 60 characteristics. Using panel trees, we can still do this greedy algorithm, and we can effectively search over the space of sequential shorts. That's essentially what panel trees do. I'm just going to speak a little bit louder. I'm outside, so there's some background noise. This is what happens if you run panel tree on US equity data. And I'm not going to restrict the sequence, right? So this is purely data driven. It turns out that the first split data tell me is I should split using the volatility of trading volume, the dollar volume standard deviation as my first split. And my second split should be market equity, industry adjusted. And the third one should be momentum uh, uh, based criteria. So basically, data are telling me how to split the assets, the cross section of assets, in order to best price all the assets. And if you look at the performance, asset pricing performance, there's a number of standard metrics that we use in finance or economics. In sample, we do both total R square and predictive R square, both looking at in sample and out sample performance. But we have to talk about what assets we're pricing, right? We can use individual assets. We can also use portfolios of assets. So here I use P-tree 1, P-tree 3, P-tree 5. That means how many factors we are using when we apply the P-tree model. You can use boosting to generate multiple factors. MA P-tree means market adjusted P-tree. Basically, you can regress on the market factor first and use the residuals, pass them through a P-tree to generate P-tree, additional P-tree factors. The rest are standard benchmarks from a French three-factor model, CAPM model, risk premia, PCA, IPCA models. Those are more recent. In terms of pricing performance, P-trees do a great job in pricing both individual stocks and portfolios. It's among the best performing. And even though models such as IPCA would do pretty well in pricing individual assets, actually does pretty badly for pricing portfolios. But P-trees will do better. And more importantly, P-trees are interpretable because you see exactly where we split. We're not using ensemble method. And you can show the global criteria, the fact that we are requiring the growth of tree to maximize the pricing performance across the entire universe of assets in our data. It's going to help guard against overfitting because you're still using all assets. You're not using assets only in the node, which as the tree grows become less and less, right? And that introduces more noise. So that's how this works. Um, you can introduce time series split, and that allows interactions of time series of macroeconomic variables and firm characteristics or asset characteristics. Why is this useful? Well, if you're a portfolio manager, essentially the data are going to tell you, well, splitting along the inflation is the most important time series or macroeconomic variable. And in different inflation regimes, high inflation regime, low inflation regime, we're going to have different characteristics to split along in order to generate the leaf portfolios. And from the leaf portfolios, you can construct a portfolio and look at its investment performance. In the paper, we contain more details that's going to tell you more how to construct portfolios. And for portfolio managers, that will be very important. Now, let me move on to deep reinforcement learning. This is based on a separate application. Um, so this is joint work with Ke Tang, Jingyuan Wang, and Yang Zhang. And this is probably the very first careful application of deep reinforcement learning in portfolio management. So why do we need deep reinforcement learning for portfolio management? Well, we have to ask how we typically manage a portfolio. We typically do it in two steps. The first step is we estimate the asset returns, return distribution, expected return distribution. And in particular, if you're doing mean variance optimization, you just need to estimate the first two moments. And then the second step, we construct a portfolio. Second step is easy in the sense that if you give me the first two moments estimates, I can do mean variance optimization. But the first step is where the challenge is. We typically have a lot of estimation errors. The weights of the assets within a portfolio are very sensitive to small differences in the estimates. So the question is, can we do a direct construction of portfolio based on input characteristics? Well, we could try to do that, but if we use supervised learning, we need labeled data. And if the portfolio management objective is very flexible, say I want to maximize cumulative return subject to the portfolio never losing 50% because the fund might be closed whenever it loses 50%. That portfolio or that metric is not observed in historical data. So that's why we need reinforcement learning. The data essentially are labeled. And in order to incorporate interactions with the environment, reinforcement learning is a perfect fit for accommodating price impacts or interactions of state variables, right? Whether the fund survives at a given point in time would be a state variable, and supervised learning wouldn't quite do the job. Why do we need deep reinforcement learning? Well, we need to use neural network to deal with all the distinguishing features of financial data, right? High dimensionality interactions, so on and so forth. So that's why we use deep reinforcement learning. There are economic motivations for doing this. But at the same time, if we use deep reinforcement learning, interpretation is a challenge. So what we do in the second half of the paper is to introduce what we call economic distillations. The idea is to project a complex model onto simpler models in order to interpret how the complex model behaves. This is different from distillation in computer science, where we're distilling a smaller model for deployment. That's not our goal here. Our goal here is purely for interpretation. So that's different. We still use the complex model to trade, to manage the portfolio, but we want to understand how the model actually create outperform. Um, so how do we construct the model? Well, the architecture of AlphaPortfolio has several modules. The first step we do is we can pass the time series information of an asset, such as earnings, performance, even diversity of the board, right? High dimensional input variables for a particular asset. You can use lagged variables. So it's a long time series in multiple dimensions and pass it through a sequence representation extraction module, such as transformer encoder. That's the model we use, or long short-term memory. That's something we use. By the way, we post the codes for the panel tree and textual factor models that I'm going to talk about in a few slides, all on GitHub. And in the paper, you can find more details on how exactly we develop the model. So here is just a broad overview. So we can pass the time series of individual assets into this first module to generate a abstract representation of information, right, in the time series. For asset I, that will be Ri at time t. But we were talking about risk diversification interactions of asset returns, so we can't stop here. What we do is we introduce a cross-asset attention network. It's very similar to self-attention mechanism, but it's just structured across the assets. So once we pass through that module, you generate some scalar outputs for each asset, which we call winner scores. We're just going to rank assets based on the winner score to construct portfolios. Is it going to perform very nicely? Well, so far there's no economics yet, right? So the portfolios might be performing quite badly initially, but that's where reinforcement learning will come in. If it's performing badly, you can search away from the parameter region. If it's performing well, based on the gradients, you can search in the direction that's improving the objective of portfolio management the most until the model converges. And it's going to perform quite well. And here I'm just showing you a table of the performance of AlphaPortfolio. Um, Here we're just optimizing auto sample Sharpe ratio, monthly rebalancing, so it's not high frequency at all. Bigger than Q10 means we're excluding the bottom 10 percentile of equity assets. We're using US equity as an illustration. Why do we exclude small assets? Well, they are illiquid and they tend to drive a lot of the anomalous performance or excess returns. So we want to say we're not relying on illiquid, non-tradable assets. So this is very tradable. And you look at the Sharpe ratio auto sample, it's consistently above 2, which is quite high. Turnover is very low. Average holding is about 4 months of assets. So it's very implementable. And you can control for various risk factor models, right? From a French factor model, Ho-Xie-Zhang, Stambov-Yuan factor models, the annualized alpha is still consistently over 13%. In the paper, we perform a number of robustness checks, and that's very important. We need to make sure economic restrictions are carefully tested, right? It's not only about statistical prediction based on the data. You need to impose economic restrictions during high illiquidity episode or sentiment episode, um, or over low sentiment episode. We want to show the model is robust, right? Those would require certain finance and economic knowledge, and that's where I think economists can add quite a lot to this process. Now, performance is really great, one of the best performing models out there. What about interpretation? Well, if you project the model onto linear regression models, modeling space, you can actually figure out which characteristics and their higher order terms or interaction terms are contributing the most. It turns out in this particular case, inventory changes scaled by total assets is the key contributor here. And some other signals rotate in and out. In fact, we see alternations of market-based signals and characteristic-based signals. You can also project the model onto textual space by looking at the 10K, 10Q filings of firms, and just to see what these firms are discussing when we take long or short positions in them. I don't have time to go into the details. This is based on a textual factor model that my co-authors and I introduced in 2018. Um, the idea is to combine word embedding and topic modeling through the local sensitivity hashing. Um, but the main idea is just to build a natural language space and figure out the spanning vectors and then project the firm's document onto these spanning vectors. Then you know what vectors is this firm loading on. It's essentially a factor model, right? And we can interpret those spanning vectors by rotating them using a topic modeling approach. So if we do this for AlphaPortfolio, you can see when we are taking long positions, we're really looking at firms that talk about cash flows, sales growth. We take short positions with firms that talk a lot about corporate events, mergers, acquisitions, or firms that are talking about real estates, right? Both residential and retail. So you can get an initial understanding of what might be the theme that people talk about. I'll just spend one more minute to mention a potential application of deep reinforcement learning in corporate finance. So far, the research in corporate finance has been focusing on causality, but causality is not extendable to broader or wider parameter regions or when managers are making multidimensional decisions. But we do have a lot of data. So what you can do is you can build a environmental module just to model the whole environment and then use reinforcement learning to figure out the best combination of actions for the manager to take given a objective. And that's what we do in this study, recent study that we call alpha managers. But you can do more. There's a lot of debate on managers maximizing equity value, shareholder value, or employee value. Are they managing social, environmental objectives, governance objectives versus just market valuation? So you can actually use inverse reinforcement learning, combine that with reinforcement learning, which essentially forms a generative adversarial network, in order to infer the manager's objective, at the same time recommending the best policy action. So I don't have time to talk more about that, but hopefully we're going to post this soon, and happy to share with you if you want to drop a note or email. But that's the start of applications of AI models in corporate finance. I think that's also a very promising area of research. So I'm going to stop here and conclude. Essentially, there are many interesting directions combining what we know in AI and machine learning and the knowledge of finance. In terms of asset pricing applications, I've shown you how we can construct regression, a new class of regression trees that are particularly suited for asset pricing or portfolio management. We can also think about the application of deep reinforcement learning or constructing interpretable textual analytics that would relate what we do to the typical regression analysis, and also preserving the interpretability that we get from natural languages.